My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make you a little money. My job, not just to entertain, but to educate, teach. Call me at 1-800-743-CNBC. Tweet me, Jim Cramer. On a day where the Dow inched up 38 points, S&P dipped 0.16%, NASDAQ declined 0.3%, I'm willing to declare that there's too much doom and gloom out there. Look, I'm not trying to call bottom. I want to make that crystal clear. But I think it's worth taking a hard look at what's actually going right, not just what's going wrong. Look, the market's up so much for the year as we head into a tricky election and enter what's historically the worst month of the year. So only a fool would ring the all-clear klaxon. Plus, we aren't even oversold, at least according to the S&P oscillator that I swear by, a gauge that identifies when there's too much buying or selling versus normal times. You don't go in when the market's overbought like it is now. It almost never works. But at the risk of sounding too bullish, let me try to refute some of the biggest and baddest stories out there. First, there are many themes floating around Wall Street ether. The chief one right now is that the economy is slowing at a much faster pace than the Federal Reserve is prepared to combat. Therefore, we're doomed to a recession. That's why the consumer packaged goods stocks and the utility stocks are roaring, while the economically sensitive stocks have indeed been crushed. I don't deny that the economy is weakening. You don't get the collapse in prices of Dollar Tree off 55% for the year, including today's 22% beatdown in the wake of a very weak quarter, or Dollar General with another disappointment just last month without a weaker economic backdrop. Well, what do you expect? See, we can't hope for the Fed to bless us with a rate cut or rate cuts unless the economy's deteriorating. They don't cut rates when business is good. You can't wish for a rate cut and not accept that there are going to be some blow-ups. That's just foolish. Yet we all act like nothing should go wrong and we'll get multiple rate cuts anyway. Like we're rewarded with that? Wrong. They're meant to combat economic weakness, not strength, for heaven's sake. At the same time, people forget that the Fed will take rates down precisely in order to prevent a recession. Yes, I'm sure if we get a really weak labor report on Friday, we'll see a huge rally in the recession-proof stocks again, even if they could be hurt by political meddling. Or in the case of the food and beverage plays, the rise of these GLP-1 drugs. Of course, if non-farm payroll number is too strong, then we can't have the rate cut cake and eat it too, can we? How about the tech weakness as a sign of recession? I keep hearing that NVIDIA might have missed its quarter because of economic weakness. Hey, can we just please put that aside? The people saying this are the same people who call the stock NVIDIA like it rhymes with Nivea or something, like it's this instead of NVIDIA, which is how you pronounce it. The simple fact is that NVIDIA's problem is that it couldn't produce enough of its high-end Blackwell chips. It was supply, not a lack of demand. Can't they give these people a pronouncer? Don't call it that. Now, we know from the last round of semiconductor conference calls that we've seen a bottom in all sorts of inventories, including cell phone and industrial. That's excellent news for Micron, which has been in free fall. Marvell Tech, which would be much higher if it weren't for recession chatter. Something at Texas Instruments seems to have already shaken off. How about oil as a sign of weakness in the economy? Come on, you're hearing that too, right? I'm not buying it. Although it's possible that there's a demand weakness. That would be from China, not here. We're simply pumping oil like mad. Oh, by the way, maybe this is it. If Trump wins, we could see the same thing as we did last time when he won. Oil stocks underperform. Yes, when the president supports oil drilling, it brings a ton of oil to market. It ends up suppressing the price of crude. We're that big a producer. Maybe that's the real source of weakness. Now let's deal with the most insanely prurient and misleading hokum currently being dispensed right now. Again, concerning not Nivea, but NVIDIA. There's nonstop chatter that the hideous decline in NVIDIA stock yesterday, one that destroyed $279 billion in market capitalization, is an arbinger of disaster. In isolation, that sounds pretty frightening, but allow me to offer an alternative view, please. NVIDIA started the year with a $1.22 trillion market cap. It then zoomed to $2.93 trillion by the end of August. Yesterday, it declined to $2.65 trillion. Perhaps, that big $279 billion loss isn't so big, at least in the context of a stock that's up more than 100% for the year. Oh, by the way, let's not forget about the law of large numbers. When you have a couple $1 trillion stock, $200 billion ain't that much. Oh, and this wasn't the first time that NVIDIA's market cap dropped more than $200 billion in a day. In fact, this was the 5th time. Big deal, but not too big a deal. I know what you're thinking. NVIDIA stock is on fragile ground. Now, that's actually something I agree with, as there are still way too many fellow shareholders who don't know what NVIDIA is, what it makes, or how it profits from all the brain power of CEO Jensen Huang and this amazing team. Let's call it the NVIDIA factor. These clueless investors all have to sell. The stock can't get a firm footing until these sunshine shareholders capitulate. At the same time, we don't know how quickly NVIDIA can get its Blackwell chip rolling or how it can get its gross margins up. By the way, that was actually the real reason for the stock's pummeling in the wake of the so-called weak quarter, their gross margins. But how about something more empirical? Deutsche Bank put out a list of the biggest previous drops in the market, and it's pretty revealing that these tend to be great buying opportunities. For example, Meta Platforms shed $251 billion in market cap on February 3rd of 2022, but since then it's rallied 116%, trouncing the S&P's 23% gain over the same period. On April 29, 2022, Amazon lost $206 billion in market cap. Since then, it's rallied over 39%, beating the S&P, which is up 33% and change. On September 3rd of 2020, Apple lost $180 billion in market cap. Since then, it soared 83% versus a 60% gain in the S&P. On October 25th of 2023, Google dropped $180 billion. Since then, it's come back with a 25% gain. Not bad, but it's the only stock on the list that failed to beat the S&P, as the index jumped 32% in that time. Finally, Microsoft lost $178 billion in market cap back on March 16th of 2020, then went on to surge, a rampage, 202% versus a 131% win for the S&P 500 over the same period. After examining these figures, you could easily argue that the real winners tend to experience a terrifying degree of volatility. It often scares people out of these stocks when they should be buying more. Every one of these moments was ultimately a terrific price to buy, not sell. Finally, let me tell you something else that might cut through the gloom with a machete. If you have a market that's been driven by a handful of stocks, and then suddenly it's being driven by healthcare, consumer packaged goods, and financials, utilities, are we to presume that's somehow a bad thing? If everything were to go down, sure, real bad, but not this time. The bottom line, we have a ton of stocks that are rallying here, giving us much broader leadership. Again, like the rate cut that's coming, isn't that exactly what we want? Isn't it? William in Connecticut. William.
Hey, Jim, my 11-year-old son, Will, has a question for you.
Sure. Oh, yeah.
I was studying stocks for my 5th grade class, and one stock that was doing really well was Royal Caribbean. They added a new ship to their fleet, and the stock almost doubled in value in the past year. Is it still a buy?
Boy, there's a kid with horse sense. I got to tell you something, William. Listen to me. This is the best operator right now. They're doing a terrific job. Even the others are not. The others are kind of faltering, but not these guys. I think it's a great long-term investment. People did not decide to leave sailing during COVID, and they've embraced it more than ever now. Robert, New York. Robert.
Hey, Jim. How you doing tonight?
Not bad, Robert. How about you?
Good, Jim. I'm doing great. I couldn't be doing any better because if you recall when we had our conversation a few weeks ago, we spoke about a stock that you recommended at 19, and I rang the register when you said it'll go into the 30s, and I had 4,000 shares. You made me 40 grand, baby, on Chewy, and thank you so much. Does everybody remember that? Does everybody in America remember that conversation Jimbo and I had?
I appreciate it. My team does. The team that's been with me forever understands. Thank you for bringing it up. I really appreciate it.
Because, Jim, I religiously listen to everything you say, and you are the man, okay?
But remember, I make mistakes. I own them, but I make them, okay?
Maybe you make 1 out of 100 mistakes. I haven't seen too many, but it's my opinion. I mean, I think you're
everything
right on the
I do
mark,
with my
Jim.
trust is public, so you can just count the errors if you want to. But thank you for those kind words. Thank you.
Thank you, Jimbo. Anyway, Jim, this next stock has a huge lead in the weight loss industry. Sometimes it's very hard to own winners during a periodic sell-offs. But this drug company, in my opinion, I'm sure you're going to agree with me on this one, and you're going to hit that bell for me, could be the next trillion-dollar company, okay? Their diabetic drug alone, Mufanda, got approval in China, and China is the most highest diabetes in the world, okay? Yeah. So the bottom line is this. The company is expected to see about 120% earnings growth this year and 40% next year. GLP-1, Jimbo, Eli Lilly.
Okay, I think, first of all, those comments were extraordinary. Thank you, Robert. Eli Lilly is going to be, I believe, yes, the next $1 trillion company. It's $900 billion. And I think that it's just been remarkable. We did trim some this week because I felt so greedy for the charitable trust. I hadn't taken any profits in a long time. But yes, we did that so we might be able to buy some if it comes back down. Thank you so much. Let's go to Ian in North Carolina. Ian.
Jimmy, how we feeling about your birds tomorrow?
Well, we're going down to Brazil. I talked to Harry Roseman. He says they're on the plane. They were on the plane. I tell you, I like it because it's on NBC and on Peacock. There you go. Because I play for us. What's going on?
I love it. Well, listen, I am personally pretty bullish on the long-term secular trend around rare earth materials. Am I on the right track with MP Materials?
They are now a show-me story. I've got to tell you, I've been backing them for a long time, but I am not going to back a company that has not been able to capitalize off of what is an absolutely important, incredibly advantageous position they have, and they're not making money. And that's why the stock is down 30% for the year. Okay, we have a ton of stocks rallying right now. It's healthcare, finance, utilities. Come on. We're getting broader market leadership. We're getting rate cuts. My question is, are those bad things? Mad Money tonight. Should you stock up on Sprouts Farmers Market after the late July report? I'm checking with the CEO to see what the fresh food retailer has in store. Then Dick's Sporting Goods falling after earnings. So what's behind the move? I'm cracking open my post-earnings playbook. And do not miss my exclusive with defense player AeroVironment, straight off the company's After the Bell report. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
This has been an incredible year for Sprouts Farmers Markets. That's the grocery chain focused on natural and organic food, but the stock is up more than 100% for 2024. In all honesty, I wish I'd devoted some time to this one because it's really been an incredible operator. When Sprouts reported at the end of July, the company delivered a magnificent beat and raise quarter, which allowed the stock to soar from the mid-80s to the high 90s in the span of a few days. Tremendous same-store sales, big earnings beat. However, this growth stock, it's sold right now. It's pulled back over 6% from its highs last week. So could this be a chance to pounce? Or is it a reason to ring the register? Let's take a closer look with Jack Sinclair. He's the CEO of Sprouts Farmers Market to learn more about the operation. Mr. Sinclair, welcome to Mad Money.
Thank you for having me, Jim. It's nice to be here.
It is a true joy to meet a real operator who knows what people want. They want fresh, they want organic, and they also care about price and don't want to pay too much.
Yeah.
How have you been able to perfect this formula?
Well, I've been very lucky to inherit a company that's had that heritage from the very start, that heritage of really good value fresh produce, heritage of bringing healthier products to customers, and we're building on that by trying to evolve the assortment, evolve the proposition, all the time looking at the value that we're giving customers on it. And produce pricing is a really important part of our proposition. That's what's been bringing a lot of customers in right from the start of Sprouts, and as we grow across the country, we want that reputation for being the place where people can get healthy, affordable, giving access to people for healthy, affordable foods.
All right, so a lot of people would say, until I met up with your outfit and your numbers, hey, you can't lower prices. There's nothing you can do. This is the way it is. The world is. You have been able to somehow make a lot of money, but still make really good prices for all the people who shop at your stores.
And a lot of the reason, well, first of all, produce is a very important part of the proposition. The other parts of the store, we're very differentiated, whether it be vegan, vegetarian, keto, paleo, plant-based, all of those products, we kind of own those space for ourselves. And if we give good value to the customer, we get good response from the customer on that. And we're constantly looking at our own pricing and what we do ourselves, as opposed to looking at what everybody else is selling different things for. So we can run our own business and focus entirely on delivering for our target customers. We're not trying to look after everyone. We're trying to look after that target customer that's interested in healthy foods and want to understand what's in their food.
In the meantime, the target customer clearly loves you, and we know you over-index on some key lifestyle choices that indicate that your customers are very smart And not just, could go anywhere, but they go to you.
Yeah, and I think the reason for that is because we've got that differentiated, attribute-based assortment. The fact that we're able to sell so much online says to me that people are actually migrating. I want the curated assortment that Sprouts has, and that allows us, I think, to attract those customers who are a little bit more focused on what's in their food and how they eat and what their diet is, and that's been the big driver for our business.
At the same time, you've done something that I find remarkable. A lot of people give lip service to local. They might even have like a little kiosk local.
Yeah.
You have foragers who are actually trying to find great things in the areas that you're at.
Yeah, and we've got distribution centres across the country. In each of the distribution centres, there's people looking for the appropriate things locally. So in Colorado, there's a short window where you can get fresh produce. We do a really nice job in that space. And right across the country, that's a part of it. And this foraging team that we have, they're always out looking for something different and something local, and it's working well for us.
There are customers who are awaiting your loyalty program, betting that it's a little different from the traditional loyalty program. Could that be the case?
Well, absolutely. We're not keen on the traditional grocery loyalty scheme about free gas and discounted prices for different customers. What we'll be doing is trying to create that connection with our customers. When we get more data, more information, we'll be able to communicate very directly what customers want and make them feel special, because there is something special about our speciality business, and that specialness will come alive as we get more and more data from our customers.
I think it's also important now. I see a lot of retailers and they overexpand. You're clearly not doing that, and they don't care enough about shareholders. You're not doing that either. You are actually buying back stock and expanding and making money on the stores rather quickly after they open.
A big part of the store program that we're developing, we're building about 35 to 40 stores a year, and the big part of that is we've made them a little bit smaller so that there's better returns. They cost less to build. Make them a little bit smaller. That's allowed us to get much less risk for the shareholder in terms of the investment. We're building those stores from sea to shining sea. Jim, we're really excited about right across the country, and people are reacting to it. Everyone knows us in San Diego and Southern California, but when you get over to Mid-Atlantic and Florida, we're working, and I'm so pleased at the reaction we're getting right across the country on those stores. And in the middle of that, we're generating a lot of cash and giving cash back to shareholders as appropriate going forward. We always focus on the business first, but when we've got some money extra, we're giving it back to shareholders.
As a grower and as a person who makes sauce and a lot of other things, we do have great peaches in New Jersey, okay, and we have tremendous beefsteak tomatoes, and we have Silver Queen corn in Pennsylvania and New Jersey. Will you have those?
We will chase after those right away, given you've asked for them, sir.
Well, I've got to tell you, I really felt terrible when I was reading into the operation. We had Sprouts on many, many years ago, and then we lost touch with it. That's just our bad. You're a remarkable operator doing great things.
Well, thank you so much for that. We really appreciate your comments.
All right. I think that down 6%, buying opportunity. That's Jack Sinclair, CEO of Sprouts Farmers Market. Mad Money's back after the break.
Coming up, is it first and goal for Dick's Sporting Goods? Cramer takes the snap on a brick-and-mortar all-star. Next.
All right, what the heck just happened to the stock of Dick's Sporting Goods? The sporting goods retailer reported, I thought it was a great quarter this morning, but the market thought they dropped the ball. Sent the stock down over 10% right when the market opened. That's insane. The quarter was really good. Dick's delivered 4.5% same-store sales growth. The Street was only looking for 3.4%. Net sales were higher than expected. Earnings per share came in at $4.37. That's a full 51 cents higher than anticipated, not to mention up 55% year over year. The pre-tax margins, they jumped from 10.1% a year ago to 13.9% today. That's very hard to do. In short, the company's firing on all cylinders. Plus, Dick's also raised part of its full-year forecast for the second quarter in a row, boosting its same-store sales outlook and its earnings guidance. So then what was the problem? Why were people selling the stock down 10% this morning before the stock somewhat recovered over the course of the session? All right, let's start with the raised guidance that I just mentioned. While Dick's reported a clear beat and raise quarter, their guidance wasn't truly better than expected. They just brought the numbers closer to what the analysts were already looking for. The earnings forecast hasn't even truly caught up yet, and the revenue forecast is still lower than what Wall Street's expecting. Okay, not perfect. At the same time, the new full-year forecast from Dick's also implies a slowdown in the back half of the year. They're talking about 2.5 to 3.5% same-store sales growth for 2024, which is less impressive when you remember that they just posted 4.5% growth for second quarter. And in the first quarter, it was 5.3%. When you do the math, That means Dick's is actually projecting same-store sales in the 0 to 2% range for the final 2 quarters of the year. On the earnings side, they just reported a 51-cent beat, but only raised their full-year forecast by 17.5 cents at the midpoint, which is a de facto guide down for the rest of the year. Now, that wouldn't have been too bad, except Dick's Sporting Goods has been an incredible stock in recent years. This thing's traded from $63 and change at its lows in May of 2022, all the way up to $232 at last night's close. And the stock was up 58% for the year. Basically, Dick's was trading like we had a genuine beat and raise quarter, but instead we got more of a beat and pseudo-raise quarter. Of course, that's not the only reason the stock got clobbered today. When you read through the conference call, I think there were a couple of remarks that spooked people. First, one reason Dick's only raised its full-year earnings forecast by 17.5 cents is that the company decided to make some, and I quote, strategic investments to drive long-term growth, end quote. Specifically, management's been investing in the stores and in new technology. And so far, they like the results, so they plan to double down. Hey, that's going to eat into their earnings. But given how well these upgrades have been working for the company, geez, I think that's a great use of funds. Unfortunately, there's a cohort of investors that's allergic to this kind of investment. It's possible they sold first, maybe ask them questions later, maybe ask them not at all. Second, this shouldn't have come as a surprise to anyone who is seriously following the stock. But on the call, Dick's alluded to the fact that its results might have been artificially strong in the first half of the year. Some of their robust same-store sales growth came from the fact that they were lapping periods where a decent number of stores were shut down for renovations as Dick's rolled out its new House of Sport format. So some of the strength was simply because the stores were closed the year before, although it certainly helped that the House of Sport has proven to be a very popular concept, which is what I really care about. At the same time, their back-to-school week came in the second quarter this year, but last year was in the third quarter, and that definitely gave the same-store sales another, what I guess can be called artificial boost. Now, are these valid reasons to sell the stock? This is really the gravamen of the situation. Honestly, I don't think so. For me, the new investments are pure positive, and even when you back out the artificial same-store sales boost, the numbers would have been merely good, not great. In the end, I think many shareholders will look for a convenient excuse at all times these days to ring the register on a stock that's tripled over the past 2 years. Frankly, anything less than a stunning set of numbers likely would have made these people take some chips off the table. I don't blame anyone for ringing the register on a big winner, but you seriously don't need to wait for an excuse. If they'd sold ahead of the quarter, they would have gotten a better price. That said, I think we'll look back on this pullback as a buying opportunity because there are so many good things happening here. Dick's still has one of the best omni-channel offerings of any retailer, and people will never stop coming to the store in person for soccer cleats or baseball bats or golf clubs because these are the things you really need to do in person. Doesn't hurt that Dick's has its own batting cages and golf simulators. Hard to Amazon those. Meanwhile, the House of Sports stores and its new generation of 50,000 square foot locations, calls them field houses, are doing very well. In a new wrinkle that we hadn't heard before on the call, Dick's management noted that their landlords have significant interest in these House of Sport locations because they make terrific anchor properties for entire shopping centers. That's how much traffic they bring in. Dick's currently has 15 House of Sport stores with plans to open another 5 this year. They also have 17 field house locations and are adding another 9 this year. All terrific. Hey, don't forget, by the way, they have this Game Changer app, which helps parents track and even watch their kids' games. This has become a great source of new business for Dick's because they get a list of potential customers every time a new team signs up to track its games. They now have more than 6 million unique users engaged with Game Changer, and the average user spends roughly 45 minutes per day on this app. I know I'd have loved this back when my eldest was in high school. I still feel terrible about some really big games from 2008 when the financial world was teetering and I was stuck here. Now, I can't even remember what happened in those days, but we both remember my missing those big championship matches. Finally, Dick's keeps making excellent merchandising decisions. This year, they've been leaning into lifestyle products and finding real success. They've also made major investments in the brand, including a recent deal to become the official sporting goods retailer for the Team USA at the LA Olympics in 4 years. Hey, by the way, they just ran this amazing ad campaign during the Paris Olympics. So I'm feeling pretty sanguine about Dick's Sporting Goods after the quarter. Certainly much more sanguine than the market seems to be, although the stock's already recovered more than half of its losses from that 10.6% beatdown this morning. At these levels, Dick's sells for less than 16 times this year's earnings estimates. It's cream of the crop retailer. I think it's got a lot more room to run. Bottom line, I think Dick's sold off today because it was up huge going into the quarter, and profit takers were simply looking for any excuse to sell. After the sell-off, though, I say you're getting a fabulous buying opportunity in a stock that deserves to be substantially higher. But in the gloom that abounds, conservative guidance, which is what we got here, you get what people think is hard gospel, when it might be just a need to play it close to the vest in an obviously uncertain time. Let's take calls. Let's go to Raj in Illinois. Raj.
Hey, Jim. My question is regarding Celsius Holdings. It's come down considerably from its highs of the year. Is it a buy at these levels given the partnership with Pepsi and obviously the drop in price?
I've got to tell you, I saw it this afternoon. I looked at it down 3. No, I think there's something wrong, by the way. Whatever that relationship is with PepsiCo, it's sure not helping them. The stock had been a rocket ship. It's come back down. I like to wait till companies don't have some sort of footing. This one is just still in free fall. And a lot of it is a belief that perhaps they are selling it at lower prices than they thought, or at the convenience store it's not selling as well. I don't trust it, is what I'm saying. Let's go to Sonny in Illinois. Sonny.
Hey, Jim, a big Chicago, Windy City booyah to you, my friend.
Oh, a bear, and like the Bears, Windy City booyah, right back at you. What do you got for me?
Hey, man, I want to give a shout out to Nicole and your staff. They're doing a phenomenal job.
They sure are. Nicole is just fantastic, and the staff is great. What can I say? South Jersey person, Nicole. I like that.
That's good.
Just like you like Chicago, I like Philadelphia.
Take care of her. Make sure you give her a nice raise every now and then, huh?
I wish I were in charge. I would. Okay. How can I help?
Well, hey, Jim, I got a two-part question.
Okay.
Hey, and I just remembered, I'm still waiting on the sequel to Get Rich Carefully. When is that new book coming out?
Stay tuned. All right, stay tuned.
Okay, buddy. Sounds good. So I got a two-part question pertaining to Signet Jewelers.
Okay.
Now, with gold and silver near record highs, do you think that's going to, impact them in a positive way? And with Signet kind of coming back near the $80 level, do you think it's a safe time for me to build a position ahead of their earnings next week?
Okay, these great questions, and thank you for the nice comments about the staff. I would tell you this. What worries me is that not the price of gold and silver, but the stock just acts so terribly, but it sells at 7 times earnings. I think that Gina Drosos does a terrific job, so I'm in favor of the idea of starting a small position right here and let it come down and buying more. The last quarter was fine. It was not a great quarter. It was not a bad quarter, but the stock is very inexpensive. Thank you again. Profit takers were looking for an excuse to sell Dick's Sporting Goods, but I think we'll look back at this pullback as a buying opportunity. Much more Mad Money ahead, including my post-earnings exclusive with drone maker AeroVironment. Plus, I'm checking in on the latest with the Department of Justice and the pursuit of big tech companies. And of course, all your calls, rapid fire, tonight's edition of the Lightning Round. So stay with Cramer. Last, we've got some great news from AeroVironment, the defense contractor best known for its Switchblade suicide drones, which have played a major role in helping Ukraine fend off the Russian invasion. These guys won a nearly $1 billion contract to supply those same drones to the U.S. Army in response to the stock surge from 177 to 203 over the next couple of days. That's something to keep in mind when you see the stock getting slammed right now in after-hours trading, because Wall Street doesn't seem to love the numbers AeroVironment reported after the close. The actual quarterly results were fantastic, but the company only reiterated its previous full-year forecast rather than raising it, and the analysts expect it to be raised. Then again, that forecast doesn't include the big U.S. Army contract these guys just won last week, which makes the whole situation a little confusing. We're going to clear that up. Let's cut through the noise and get the real story from Wahid Nawabi, whom we've had many times. He's the chairman, president, and CEO of AeroVironment. Mr. Nawabi, welcome back to Mad Money.
Great to be with you, Jim.
Well, it's great to see you, sir. And it's been many, many times you've been on. I thought maybe you could just kind of clear up some sort of mystery because you got that big contract. I think some of the analysts thought it could be in, but it looks like that's not the case. Maybe you can just describe the events that occurred here so that people realize that it's not like you are guiding things down or not happy with how things are going.
Absolutely true, Jim. We are very, very excited about the quarter and the year. We had a fantastic quarter, a record first quarter for the company in its history, the largest ever single contract, IDIQ, indefinite delivery, indefinite quantity of nearly $1 billion with the U.S. Army for Switchblade variants, both Switchblade 300 and 600. Our Switchblade business grew over 68% in the quarter. Our overall business grew 24% top line Q1 of this fiscal year. So we're very excited, and we reaffirmed our guidance, which is, again, another record year, both in terms of revenue and profits for the company in fiscal year 2025.
Well, I think that might be the problem, sir. On slide 7, you talk about maintaining guidance. I think with all that good news and the big contract you just won, there would be ample reason why you would raise guidance.
So, Jim, there's several factors involved. Number one, we are in an election year. the U.S. government, all the indicators are that might go into the U.S. Defense Department will be another continuing resolution, which means that their government fiscal year 25, which actually gets approved sometimes and it starts in October of this year, they'll get delayed all the way until the end of this calendar year. It is our first quarter, which usually is first inning of a 4-inning year. And so we're kind of early in this process. Again, we had a record quarter, record results in terms of our performance of our business, and the growth is substantial. We're really building for the long term, and we could not be more delighted about the opportunities in front of us, as well as the prospects for prosperity and growth and value creation at AeroVironment has never been better. I'm really excited about it.
That's what we wanted to hear. Well, that's what I feel the case was. These are tricky times that you don't know because it's still political. We don't even know who's going to be president for everything. Now, let me ask you. We read all these stories about many different kinds of drones. I imagine all drones are not created equal. Is that correct, sir? Absolutely true. Absolutely true. So what happens if you have these really cheap drones from Iran that can send up thousands of them? Yours are so expensive maybe versus those that it's an unfair advantage. So first of all, our drones are incredibly affordable relative to the drones that many of our adversaries would design and build, including the Shahids and all that, number one. Number two, our drones perform way, way better. The effectiveness of our drones and our loitering munitions versus our competitors and versus adversaries is a huge, huge difference in gap. And third, look, our systems are so effective in Ukraine that we have so far delivered over 475th Puma systems for ISR. It is the workhorse of Ukraine. It is what the Ukrainian military is relying on a day in and day out basis. They're flying them 24/7, and it's essentially almost acting as their Air Force. Our loitering munition is very, very unique and very, very unique in terms of its mission capabilities, its effectiveness. It's taken out artillery targets. It's taken out tanks. It's taken out targets that are far beyond the visual line of sight of the military of our Ukrainian soldiers and their front line. So essentially, what we provide to Ukraine is incredibly compelling, and that's why they've been able to actually achieve so much success with it. Well, then I want to be able to dig down to this Wall Street Journal article from April 2024, where they talked about their Switchblades face initial challenges with Russia's electronic warfare systems. According to a former soldier, they talked about how they have not been as effective as people would have hoped in the article, how American drones failed to turn the tide in Ukraine. That was the headline. I mean, explain this to me, the discrepancy here.
Yeah, so most of what you hear and read on the news is related to these first-person view quadcopters and systems that are not even close to being the same as our loitering munitions, such as Switchblade or Puma systems. Our systems are designed to actually work really, really well in very heavily contested environments. In fact, last quarter, when we had our analyst day here in New York at the NASDAQ's headquarters, we were able to actually command our drones from thousands of miles away live during our investor day, when the systems that are in California and Kansas and the UAVs and our systems achieved missions completely autonomously. This is a cat and mouse game. What I mean by that is that as we make improvements and enhancements to our systems in terms of jamming and in operations in contested environment, the Russians come out with countermeasures. And we continuously actually keep updating and improving our systems. What I can tell you is that our systems have an incredible track record in Ukraine. And most of what you read in those news articles is related to other systems, not specifically to Switchblade. Switchblade is considered a very, very effective loitering munition and weapon capability. And the entire category of solutions that the Ukrainians are using, and to our knowledge, based on what they're telling us, it's unmatched in its capability. Unmatched.
All right. Thank you for clearing that up. That was my understanding, too, sir, my own work. Now, recent approval for Taiwan. Now, Taiwan is a great friend of ours, and they face possible encroachment by China. They obviously can afford to buy anything. They chose to buy yours. Why?
So they have studied the market. They've looked at all the systems that are available out there, both from the U.S. and some of our other allies. And our systems stand out for two or three reasons. Number one, our systems are battle-proven and tested in the battlefields of Ukraine and other theaters around the world. We have delivered thousands and thousands of these very effectively. We have mission relevance and mission success already. We have the production capacity that's unmatched in the industry. And lastly, we design and develop and deliver the best-in-class systems that's out there. So based on all those factors, Taiwan decided to actually ask and receive our systems, and we're going to be getting it pretty soon. We just got the approval to be able to sell them those things. The contract actually is still not reflected in our backlog. So there are several more contracts that we expect to book in the next several quarters on our loitering munition and switchblade category.
All right. I find this very encouraging, sir, and I'm glad you came on, both because the journal article seemed a little bit difficult for me to understand, and because the guidance I now understand quite well. That's Wahid Nawabi. He's the chair, president, CEO of AeroVironment. Sir, it is always terrific to have you on the show. Thank you.
Great to be with you, Jim. Thank you very much.
That Money's back after the break.
Coming up, hit us with your best shot. An electrified fast-fire lightning round is next.
It is time for the lightning round. Everybody, that's a wrap. Girls, I'm saying let's talk about my buy sales. Don't know the Florida stocks ahead of time. We say over the buy on the block. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. I'm going to start with Charles in New York. Charles.
Hi, Jim. How are you?
I am good, Charles. Thank you for asking. How about you?
Terrific. I've been watching you guys for almost 7 years now.
Thank you.
Turned me on to some terrific ideas, not the least of which was Microsoft back when it was in the 90s, and I was scared whether it was going to be a loss. And he said, no, we're 100.
No, that's when it was part of the help bring that IPO into Goldman Sachs. How can I help?
One of your ideas was Moderna, and I bought it. And
which one? Moderna is a problem. They should be making money. They should have been able to do more with the money they had. They have not succeeded. They are losing money hand over fist. They have got to clean that up, or that stock is not going to rally. Thomas in Maryland. Thomas.
Hey, Jim. How you doing?
I'm doing well. How about you?
All right. I'm a long-time listener, first-time caller.
Thank you.
Hey, I had a question for you concerning energy company OKLO, where you have Sam Altman as the chairman and board member. What's your thoughts on that company?
Okay, this is a company that, again, is losing so much money hand over fist, I can't even look at it. Even nuclear fission, it doesn't matter. You can't lose a lot of money at this structure. At this time in the economy, it won't work. Let's go to Tejas in Texas. Tejas.
Hi, Jim. Booyah.
Booyah.
How are you?
I'm doing well. How about you?
Good. Hey, I have a question for ticket symbol KKR.
KKR is an excellent firm. I've known them for years and years and years, and they have delivered time and time again. I think it's a buy. Let's go to Elizabeth in Florida. Elizabeth.
Hi, Jim. I was wondering your thoughts on Lumen.
You know, I think that Lumen, give it a chance to come down. I mean, they reported what looked like to be a pretty good quarter. I'm going to tell you, I don't trust the guys. It shot up like it can't. It's parabolic move. Parabolic move is always destined to come down. Let's go to Zach in Texas. Zach.
Hey, what's up, Jimmy? How's it going, man?
It's going all right. How about you?
That's good. Hey, man, I'm doing great. I'm in the gym, getting that pump on real quick. Hey, man, quick question. I've been successful with Coca-Cola. How do you feel about the success coming up, these 1 to 2?
Okay, first I have Nico Collins when it comes to the Texans, unless obviously you're speaking about a Dowdle from the Cowboys. Now, here's the problem with Coca-Cola. Straight up, way too far, way too fast, good company, 26 times earnings. No, doesn't work for me. Let it come in. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, don't touch that dial. Cramer has more on this market you won't want to miss. Next.
We learned tonight that contrary to news reports, NVIDIA has not received a subpoena from the Justice Department about possible antitrust violations. But we know that Justice is indeed looking into the semi-giant's remarkable strength in its generative AI franchise. Justice is after Apple, too, alleging that the iPhone makers consolidated its monopoly power by keeping its ecosystem fenced in. Oh, and next week, justice goes to court to fight against Google's alleged monopoly power over digital advertising. With NVIDIA and Apple, we've got a clearer pattern. They've succeeded by making a better product, leaving their competitors behind. And now justice is coming after them. I'd argue Google no longer has the superior product, but they're still being targeted. If you don't know anything about this business, you might find it suspicious that NVIDIA makes basically 100% of the semiconductors that are used for generative AI, but they have the best products out there, and they have almost the entire market to themselves. Now, NVIDIA was succinct in its response. I'm going to quote, NVIDIA wins on merit as reflected in our benchmark results and value to customers who can choose whatever solution is best for them, end quote. If the government is going after them for publishing benchmarks and winning orders, well, that seems like a terrible overreach to me. Let me add to that. NVIDIA finds itself in the same position as Intel back in the 90s. Intel had the best processors with AMD in a distant second. Back then, Intel had almost 90% of the market, while AMD had about 10. There was no monopoly, just a superior product. Right now, I'd argue that AMD makes excellent chips that come close to NVIDIA's, but aren't there yet, only because NVIDIA keeps advancing the ball. Customers are free to go to AMD, though, if they don't want NVIDIA. But let's be clear, none of this artificial intelligence stuff would exist without NVIDIA's technology. Second, what do the regulators really want NVIDIA to do in this situation? Should they stop making the best chips? Just today, Nature magazine reported that the Clinical Histopathology Imaging Evaluation Foundation, or CHIEF, which uses NVIDIA chips, has been able to identify cancer cells, predict tumor origins, recognize genetic mutations, and forecast survival outcomes, all essential when it comes to diagnosing cancer and coming up with a treatment plan. Does justice really want them to make dumber chips that can't help try to cure cancer? Because that's really the only way they'll lose their dominant position. Third, can we recognize, just for a moment, recognize that NVIDIA has a high-quality problem? There's a tremendous shortage of its high-end chips. The company has to decide where they go, and obviously it's going to allocate them to customers that do the most business. On Wall Street, everyone accepts that logic. It should be fine for NVIDIA, too. As I see it, this is simply an abuse of power by justice, not by NVIDIA. How about Apple? They're about to unveil a new phone that should be fabulous, but it'll be too fabulous for justice? Maybe. They might give Apple even more bargaining power versus app developers if this phone's that good. Inquiring minds don't really care. There are plenty of strong competitors to Apple. You can just go buy a Samsung. There's no smartphone monopoly, so how could there be monopolistic behavior? Finally, next week, justice goes to court to find some way to stop Google, which justice claims is, in its brief, abuses its monopoly power to disadvantage website publishers and advertisers who dare to use competing ad tech products in search for higher quality or lower cost matches. According to the brief, Google uses, quote, its dominion over digital advertising technology to funnel more transactions to its own ad tech products, where it extracts inflated fees to line its own pockets at the expense of the advertisers and publishers it purportedly serves, end quote. All right, that's actually somewhat true, which is why their ad tech competitor, The Trade Desk, is now winning over some of the world's biggest advertisers, giving them total transparency and better results than if they stayed in Google's walled garden. I say justice could save the taxpayers' money by simply dropping this case. Let it go. And let Trade Desk crush Google in its own game, at least when it comes to buying ads on the internet, especially streaming services. Now, Google was recently found to be engaged in anti-competitive behavior when it paid to become the default search engine for Apple. Yeah, they got nailed for this. I get that. They paid in order to have a terrific audience. Of course, Microsoft could have just paid more to make Bing the default search engine, but this new case is more absurd. They're going after Google for a business where they're already starting to lose in the open market. Still, I keep coming back to the Justice Department's obsession with America's best companies to keep doing amazing things. They want these companies punished for developing unbelievably great products, and I think that's insane. Apple and NVIDIA are the good guys. As for Google, when the Trade Desk came out with a better product, they started losing share. I think, really, that's all you need to know. I like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.